As per the latest report from the Federal Reserve, the U.S. consumer debt has surged to a record high of $16.9 trillion. This increasing level of debt is predicted to cause a substantial number of delinquencies that may eventually lead to defaults. The issue with the debt is not its mere existence, as an economy based on debt needs to see continuous expansion. However, when the economy slows down and the debt becomes enormous, it becomes difficult for people to make payments, leading to delinquencies and defaults. The report highlights that consumer debt has increased by a significant $1.3 trillion over the past year, and the increase is evident across all major categories, including mortgages. Despite a fall in originations, mortgage balances have risen to $11.9 trillion, indicating that debt is widespread throughout the economy. The report also indicates that serious delinquencies in mortgage loans of 90 days or more have risen to 0.57%, which is almost twice the rate from a year ago, but still historically low. Delinquency rates for auto loan debt increased by 0.6% to 2.2%, while credit card delinquency rates rose by 0.8% to 0.24%. The upcoming debt crisis is expected to occur in the credit card space and then spread to the auto loan and housing markets. As the economy expands, delinquency rates tend to decrease. However, as debt levels increase, delinquency rates rise, indicating a challenge for the economy. Currently, the rate of change in loans is high, and delinquencies are starting to increase, which raises concerns about the future. Is there a reason why consumers are unable to pay off their loans? It may not just be because the economy isn't growing quickly enough. As debt expands, the rate of change in debt increases leads to an increase in consumer prices. However, as consumer prices become too high, the growth in debt begins to decrease, leading to a decrease in consumer prices. Prices are becoming too high, and there is not enough debt expansion to support the higher prices. This causes the economy to slow down and ultimately leads to a recession. With the massive expansion of debt during the pandemic, consumer prices have skyrocketed. The latest data reveals that credit card balances surged in the fourth quarter, while mortgage and auto loan balances grew at a more moderate pace, suggesting pre-pandemic levels of activity. Despite historically low unemployment keeping most consumers financially stable, persistently high prices are taking a toll, and the rising interest rates are now beginning to test the ability of some borrowers to pay off their debts. There are two contributing factors to this problem. First, wages are not keeping up with the rising prices, resulting in people being forced to consume less. Second, the interest rate market is causing a double whammy as the Fed increases rates, which eventually hit credit card balances with a 2-month lag. This scenario has resulted in people maxing out on their debt and seeing their minimum payments increase, which eats into their discretionary spending. The end result is a slowing economy, reduced spending, and an eventual inability to repay debt. The main question is what happens next in the economy. The expected outcome is for the number of unemployment claims to decrease as debt expands and the economy grows. However, during the late stage of the cycle, as the debt rolls over and the rate of debt expansion slows down, unemployment claims tend to rise. This is because there isn't enough debt being issued to sustain the economy's growth at the necessary pace. Politicians and the people will blame the Fed as unemployment spikes, which could cause a Fed pivot and create even more inflation. The Federal Reserve's ability to combat inflation is limited, but it does have some impact on bank lending. The rise and fall of consumer credit is affected by the Fed's adjustment of the federal funds rate. This is a sign that the economy is slowing down. The delinquencies that are mounting may turn into defaults, and the banks may not be able to withstand the financial storm. It is essential to keep an eye on credit cards and car loans as they can indicate where this situation is headed. Be sure to subscribe, and thanks for watching.